So the S&P 500 is up 17% year to date with 4 more months to go. But we are entering the scariest, most bearish month of the year, September. And people have been getting more bearish. So what can we expect from September to the end of the year? Let's find out in this video. So after the pullback in August, the market has bounced back up after hitting that bottom, which coincided with the 20 EMA on weekly candles and the previous swing high. So the pullback was down about 6%, which is a very, very healthy common pullback in a bull market. My portfolio is so far beating the S&P 500 this year. It is up, let's see. Right, last 7 days up 4%. Year to date, yep, my portfolio is up 39% year to date with 4 more months to go. Now, we are entering the most scary and bearish month of the year. And in fact, data has showed that most retail investors actually turned bearish in August during the pullback. And many retail investors, and in fact, a lot of professional investors did believe that this was the high for the year, that they believe that the market was going to go a lot lower, and many of them turned bearish. And many retail investors, consensus expects the September month to be bearish as well. So one reason is because of seasonality. Historically, as you can see from the chart, September tends to be the most bearish month of the year, next to August. So you can see that since 1935, during all the pre-election years specifically, the September month has historically been up only 41% of the time. And the average return in September is 0.2%, which is one of the lowest of the year. And the median return is minus 0.4%. So understandably, people are not that bullish in September. At the same time, the consensus is that the Fed will still raise interest rates, not in the September meeting, but in the November meeting. So with rates still going up and with the jobs numbers weakening and with the bearish September, consensus is that we're going to go down in September and we're not going to go above the July peak by the end of the year. Now, while I certainly don't have a crystal ball and I don't claim to be able to predict where the market is going to go in the short term, but my guess is I think that September may end up more bullish than what people think. And I do guess that from now to the end of the year, I think we could still go up another 7 to 8 more percent. And there are 4 reasons why I am more bullish than the consensus. The first reason is because price action is still very, very bullish, and price action suggests that the market is on an uptrend. As long as the market is on an uptrend, prices will go higher until a reversal of that trend. So remember that the trend is your friend. It doesn't make sense to go against the existing trend. So as you can see from the charts of the S&P 500, we are back above the 50-day moving average. And as long as we can stay above the 50-day, for at least 5 trading days, then that new rally is confirmed, right? So this was the day we closed above the 50 moving average. That's day 1, day 2, day 3, day 4, and today is day 5. By the way, the market's closed today, which is a Monday. Tomorrow the market opens. So if tomorrow the market can stay above the 50 moving average, then I think there's a very high chance we're going to get above that high pretty soon. And of course, look at the moving averages, the 20 EMA above the 40 EMA, telling us it's a short-term uptrend. The short-term uptrend has resumed. We've got the 50 moving average above the 150 moving average, which means the medium-term trend is up. And finally, we are above the 200 moving average, and the 200 is sloping up. So all trends are aligned. Short-term trend up, medium-term trend up, long-term trend up. The second reason is that historically, when the S&P has been very bullish from the start of the year to the end of August, typically September tends to be bullish as well. So you can see an interesting research by Fundstrat. Since 1950, there were 7 instances where the S&P 500 gained more than 15% from January to August, and August was already a bearish month. So this happened in 1954, 55, 67, 75, 95, 97, and 2019. So again, in all these previous instances, year to date to August was up more than 15%, and August itself was negative. So in all those instances, what happened in September? September was up in 6 of those 7 years. Yes, it's a small sample size, but interesting to look at nonetheless. Interesting piece of statistic. So the chance that the September was up was actually 86%, with an average return of 2.9% and a median return of 3.3%. So could this happen this year? We can't know for sure, but this is an interesting statistic to look at. And from September to the end of the year, in all those instances, the market went up. 100% probability will be up for the next 4 months based on history. And the average return was 8.7% for the last 4 months and a median return of 7.9%. Will history repeat? Well, time will tell, but that's the second reason I'm bullish. The third reason is because I believe that inflation has already peaked. I've said that many, many times, and I believe that inflation will continue to go down. Now, do remember that this bear market, which happened last year, was because of very high inflation and the Fed artificially inducing this bear market by raising rates very, very fast. So once the inflation war is over, which I believe it is already over, inflation's news was last year's news. So I believe that with that over, there's no reason for the market to go back down again in that bear market. I think that this bull market is very, very sustainable. So one of the recent reports that came up was a JOLTS report in the US that showed that job vacancies have fallen to 8.8 million in July, which is the lowest level since March 2021. And now it's showing 1.51 job openings for every unemployed worker in July. This is the lowest such ratio since September 2021. So this job market that is softening is exactly what the Fed wants to see. Now remember, one of the main problems in the job market is that demand exceeds supply too much. There are too many companies looking for workers and not enough workers. In fact, it was like 2 to 1. So that created a lot of wage pressures. And that's why wages kind of like went up and drove inflation up. So with this jobs report showing that the demand is now slowly coming back down to match supply, the Fed's job is easier. They don't have to be so hawkish and raise rates anymore. And like I've said myself, I think that interest rates have already peaked. The 10-year yield, I believe, has more or less peaked, and the Fed funds rate has peaked. They're going to hold it there for a while, and they're going to eventually, cut rates maybe next year or the year after that. Now, if you take a look at the 10-year yield, again, one of the reasons why we had the August sell-off was also because the 10-year yield started to ramp up higher again, and that's what kind of like freaked people out. But we did get an interesting double top formation. We call it a double top formation, and you can see this is a classic bull trap pattern, and it formed a bearish candle over here. So we may get some relief for the 10-year yield coming back down. If you take a look at the Fed funds projection tool, you can see for the month of September, there is 89% probability the Fed will hold rates, and only an 11% chance they're going to raise rates. Now, if you look at the November meeting, there is if I'm not wrong, a 40% chance of raising rates. But I believe that with the PCE data coming up, with more inflation data coming up, that eventually the chance of them raising rates will go to zero. And that will be very, very bullish for equities for the next 4 months. The fourth reason which makes me more bullish than the average person is that economic growth continues to be strong. So if you take a look at it, it's like the economy is strong, but not too strong. That creates inflation. So we call this a Goldilocks scenario. Not too hot, not too cold, just nice. So as of the 1st of September, you can see that the Atlanta Fed GDP now growth estimates shows third quarter GDP coming in at 5.6% GDP growth. So the economy is still doing really well. Now, those of you who are in my UIP community, that's the Ultimate Investors Playbook, where you get to mirror my portfolio. You get to see my exact stocks I'm holding, my portfolio allocation, and then where I'll do the intrinsic value calculation and buy levels. You also get my live buy and sell alerts every single day. So those of you in my community, you know that in my portfolio right now, my three biggest sectors I'm holding are technology, communication services, and consumer discretionary, which are the three strongest sectors this year. And that is why my portfolio is outperforming the S&P 500. So many of the stocks that I own in these three sectors, they have kind of like gone up quite a lot this year, but some of them are still undervalued. So just to share, what I'm actually now focusing on are the sectors that have been underperforming. So remember that sectors take turns of going in favor and out of favor. Last year, technology was out of favor. Technology was hated last year. Technology dropped the most last year. So did consumer, cyclical discretionary, and communication services. And that's why last year I bought the most of these sectors. I like to buy what is out of favor, what is out of rotation, because I get them at very low prices. So this year, what is out of favor, what is hated, because I like to buy what's hated, right? You have got, so the most hated sectors this year would be basic materials, which are commodities, healthcare, real estate, consumer defensives, and utilities. Now, those of you who have taken my investing course, you would know that I would never touch basic materials. I never touch commodity companies, at least not for investing. For short-term swing trading, maybe, but never for investing. I also never touch real estate for investing, for trading, yeah, but not for investing, except REITs, of course. And I don't touch utilities. So the only two sectors that I will invest in that are out of favor this year would be healthcare and consumer defensive. So these are the two sectors that I am now watching carefully to build my positions in, because I think that there are a lot of attractive stocks coming out of these two sectors. If you want me to throw you a bit of a bone, for healthcare, one of the two stocks I'm looking at, which I really love, these are great long-term compounders with very strong moats, would be the health insurance companies, specifically United Health, as well as Elevance Health. Consumer defensives, there are quite a number of great consumer defensives that actually I sold earlier this year because they were overvalued, but I'm looking to buy them back. You know, companies like Yum Brands, as well as new additions like, for example, Hershey's Chocolates, Procter & Gamble, and Pepsi. So they are slowly getting more and more attractive. So that's the key to investment. The key to investment is to buy great companies, excellent companies, when they are cheap. And they are only cheap when they are temporarily out of favor in the markets. So that's what I'm looking at. Now, in this video, the final thing I like to cover is this. Now, what's interesting is that in August, we had this sell-off. Okay, the market went down 6%. And many people, they asked me, they said, Adam, you know, you said that the market was going to go down very soon. You said August, and indeed it go down. It did go down. And a lot of people ask me, so Adam, why didn't you short the market? Why didn't you buy put options so that when the market goes down, you make a lot of money, right? And that's a very good question that I want to answer. Now, for many of you who actually are my subscribers and you see my portfolio, and those who do follow me on YouTube, you know that I very, very rarely short the market. I very, very rarely buy put options. So in fact, I do the opposite of most people, right? So in fact, during the August sell-off, what did I do? I didn't buy put options, I sold put options. Because when the market goes down, volatility increases and option premium becomes very high. And that's a great time to sell put options, because when you sell put options, you get a very good premium, okay? You can see that the majority of my positions, as far as options are concerned, are all selling options. I very rarely buy options. I sell options almost every day. So you can see, for example, Amazon, I sold 4 put contracts Thermo Fisher, I sold 1 put contract. Pool, I sold 2 put contracts. Yum sold 3 put contracts. Microsoft sold 2 put contracts. And you can see they are very, very profitable right now. Now, I actually had a lot more positions recently, but I closed most of them and already took profit. So these are the remaining ones I've not closed yet. So why didn't I buy put options or short the market when I expected a correction in August? Well, the reason is because I used to do that many years ago. I've been in the markets now for 31 years. I started at 17 years old. I'm now 49 years old. And when I first started, I made all the stupid mistakes. And one of the stupid mistakes I made in my earlier years was whenever I anticipated a pullback or correction, I would short the market. I'll buy put options. And I'll do that to hedge my long-term investment portfolio. Because the idea is that if the market goes down in the short term, the puts I buy would make some money and offset the temporary decline in my long-term investments. Makes sense, right? That's what, in fact, most hedge funds do. But when you actually do it for many, many years, which is what I did. I did it for like about 12 years. I found that when you buy put options and you try to short the market in a bull market, your probability of making money is very low. Your probability is only like 30%. So always remember that when you try to hedge your investments, your hedgers will only make money 30% of the time. Why? Because remember that when you buy options, when you buy put options, it's very expensive. So the market, number one, has to drop big enough to cover the cost of the put options. If the market just drops a bit, you still lose money because it doesn't drop enough to cover the cost of the put options. And number two, the market must drop fast enough. So sometimes you anticipate a drop, but the market drops very slowly, doesn't drop fast enough. And because the puts you buy, they are subjected to time decay. So time is working against you because options are decaying assets. So if the market goes down but too slowly, you still lose money on your put options. So you can be right on the direction, but if you're not right on the timing, you also lose money. And that's why even those great investors and traders like Michael Burry, who try to short the market by buying put options, I can tell you that 7 out of 10 times he will lose money. And he's just hoping for that 3 out of 10 times that he makes enough to cover all the losses he lost 7 out of 10 times. Now, the other problem is even if you're right on the timing, that means the moment you buy the put, the market goes down and it goes down enough, the trouble is you don't know how fast it's going to rebound. And if you do not close your put option fast enough and the market rebounds, what happens? All the profits you make from the puts disappear. And I experienced that for many, many years. So what I found over the years is that whenever I hedge my investments, I bought put options, yes, I'll make money, but it was just not worth the effort. And I thought to myself, how do professional option traders make money? So when I spoke to my friends who traded options for the banks, they all laughed at me at that time. They said, Adam, you're an idiot to buy call options. You're an idiot to buy put options because options are decaying assets. In the short term, you can make money once in a while, but in the long run, if you buy options, you will always lose money because options, the majority of them will always expire worthless and time is working against you. So what I found is that many years ago, I learned from professional option traders working in institutions that most of them, they make money by selling options. So that's when I started doing the opposite. And when I did the opposite, that's how I made consistent profits trading options. So whenever the market goes down in a correction or a sell-off, I will sell put options. When you sell put options, you collect a lot of premium. It's like being an insurance company. You're selling insurance and collecting premium. And the great thing is this. When you sell options, like put options, your win rate is 70 to 80%. Well, at least the way I do it and at least the way I teach in my option courses. So if you want to learn that, come and learn from the option courses. Now, some people would say, but Adam, if you sell put options, isn't it very risky? Because if you sell put options and the stock keeps going down, you can have unlimited loss. Absolutely true. It can be very risky if you don't know what the hell you're doing. And that's why when you sell put options, you must follow certain very strict rules to do it in a very safe way. So, number one, never sell put options naked. Never ever sell them naked. you must only sell cash secured put options, which means you need to have the cash ready to buy the shares if you are assigned the shares. And you only sell put options on super high quality companies. Companies with a wide economic moat, companies that have got very low debt, companies that generate consistent growth in revenue, profits, and cash flow year after year after year. So in the whole market, there's only the top 1% of companies. We call them the UIP stocks. These are my handpicked stocks in the UIP community. We only sell put options on the top 1% of stocks in the world. We don't sell it on Tesla. We don't sell it on Snow. We don't sell it on PayPal. No. Those stocks are too risky to sell put options. We only sell put options on very, very safe and undervalued companies. At the same time, if you may say, I don't have the cash to buy the shares, I have a very small account, then you need to sell put options and buy another put option to hedge the first put option. We call that selling bull put spreads or selling credit spreads. It's kind of like selling insurance and buying reinsurance. And these are the exact strategies that we teach in our options courses. So I hope it's been useful. Hope you learned something today, and I'll see you guys in the next video. In the meantime, may the markets be with you, and let's see what happens in the next 4 months. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.